Business. You want to learn or business? Okay, let's go. The business for me. Come on.
Hey, Bill O'Reilly here. I'm hosting today's event once again alongside Alexander Green, the Chief Investment Strategist of the Oxford Club. But this time, we're broadcasting in person directly from Oxford's historic clubhouse just outside the nation's capital. From right here in the boardroom, a meeting place for the Oxford Club's most powerful members. We're going to show you how to make money in the market by being smart and disciplined. That's it. That's all we're trying to do. In the next few minutes, you're going to hear about a technique Alex says can do exactly that. He calls it perfect for volatile markets and says this technique is the definitive way to know whether a stock is likely to rise or fall. Now, I'm going to grill Alex on that perfect business and all that, and he's going to have to defend it. So that's going to be pretty interesting. Also today, I'm going to investigate all of the things that we are telling you to make sure that the information is accurate and that you can understand it. Now, before I bring Alex in, I want to start by telling you a story. It's a story about what appeared to be an excellent stock. Everything looked great. CEO of the company bragged that liquidity was strong, saying its primary businesses were all doing extremely well. Earnings were expected to more than triple. Wall Street singing the praises of the company. Bear Stearns wrote in 2001 that the company should be compared to leading global companies like GE, Citigroup, Nokia, Microsoft, and Intel. Goldman Sachs put the company on its U.S. select list, which is made up of what the firm considers its very best stocks. They even went so far as to compare this company to Michael Jordan, the basketball superstar. Of course, the financial media were drooling over the company as well. Fortune declared it the most innovative company in the country for 6 straight years. New York Times said it was the model for the new American workplace. Business Week even went so far as to say the risk is relatively small. Folks, you can see why many Americans bought that stock. Sounded amazing. But you know what? The name of that stock was Enron. And as you all probably know, Enron totally collapsed. The crooks running it went to prison. Complete disaster. And yet, the CEO of the company, Wall Street's so-called analysts, the bumbling financial media, all had deceived us at how great Enron was for years. They were either too stupid or too dishonest to let regular folks know the truth about what was really going on. It was all spin. But here's the thing. There actually was one way to know the truth about Enron, to completely avoid that disaster. It's a technique I first heard about directly from Alex Green. According to him, it's the smartest investment strategy of all time. Today, Alex is here to teach us this powerful secret as well. Learn it, and he says, it's like having your own personal truth detector for stock prices. You'll know which stocks are destined to fail, and more importantly, which ones are likely to succeed in a big way. Keep in mind, this technique isn't just a way to avoid failing stocks. It's a smart and disciplined way to identify some of the biggest winners in the market. In fact, you're going to see stories today of how this truth detection technique for stocks has led to vast fortunes for a growing number of regular Americans. It's used by traders like Warren Buffett, Carl Icahn, and Jamie Dimon to generate hundreds of millions of profits. Sir John Templeton made $100 million in 6 months using this kind of a strategy and called it the easiest money he ever made. He was 88 years old when he said that. There are legends of investing, of course. But regular folks who follow Alexander Green also use this to pull in substantial sums of money. And that includes me. I personally use this strategy not only to protect, but also to grow my wealth. And it's worked. And it could work for you in a way far beyond what you've experienced in the past. Now you're going to see it for the first time in your life. And that's pretty important. Only the best and most connected investors know what Alex is about to tell you. We're going to go over everything, risk, reward. I'm going to challenge Alex. Then you can decide what you want to do. Fair? If you don't like the technique or you think it's too risky, do what you think is best. We respect that. We want you to do what you think is best for you. So we've got a lot to tell you. I suggest everyone watching have a pen and paper because Alex is going to give us some very important information. He's going to detail 3 stocks he's identified with this technique that could be big winners in the months ahead. He's going to discuss how you can use this truth detection approach for yourself. And he's got a number of bonuses that he's prepared to give us today. Alex has been profiled in the Wall Street Journal for delivering maximum reward, minimum risk recommendations to his readers for more than a decade. He is a New York Times best-selling financial author with four national bestsellers and is highly sought after by major financial networks. So Alex, I'm going to give it to you now. How could Americans have used this approach to avoid an Enron, for example? How?
Well, as you said, Bill, everything looked positive when it came to Enron. Wall Street gave it top ratings. The media wrote glowing articles about it. And the CEO himself, Ken Lay, repeatedly told everyone the company was in great shape. But there was one huge red flag that stood out. There was one thing he was not doing.
What was that?
He wasn't buying his company's shares with his own money.
So he wasn't putting his money where his mouth was.
Exactly. In fact, he and all the other executives were doing the opposite. They were selling. Collectively, they sold $1.1 billion worth of the stock, all while hiding behind their glowing reviews. Now, why would they do such a thing? Simple. They knew something the general public did not. They knew Enron was going under. They knew it was a scam, and they were spinning the truth. They certainly weren't about to pour their own personal money into it.
That makes sense. In other words, Americans should have been focused on what Kenneth Lay was doing, not what he was saying.
That's right. No matter what the CEO says, no matter how much money they claim the company is making with sales, earnings, growth, market share, ask yourself this question. Are they putting their own money into the business? And if so, especially if they're investing millions of dollars, there's no better sign that the stock is about to make a big move higher.
Now, even I understand that, Alex, but there must be something more to it. I know that's the ultimate truth in the stock market. You ignore Wall Street, the media, and even public statements by company executives. You got to be skeptical. Instead, you watch what they're doing with their own money. That makes sense. So can you give us an insider putting his or her money where his or her mouth is?
Yeah, sure. I've got hundreds of examples. Let's look at Vince Holdings, for example. In April 2017, the media was bashing it. Zach said the company rated as a strong sell. And Seeking Alpha said Vince Holding was in a quote-unquote death spiral. But Vince Holding director Mark Leder wasn't shaken by the media spin. Together with 10% owner Roger Krause, the two purchased 35.5 million shares that September.
35 million shares? That's an investment that is unbelievable.
Yeah, it's certainly not to be taken lightly. An insider is going to buy that many shares only if they're convinced the stock is undervalued and likely to rise. Sure enough, the very next month, Vince Holding announced a reverse stock split along with a restructuring plan, and the stock took off from $5 a share to $22.67 in under a year. And Leder and Krause saw roughly a $28 million increase from their initial investment. And the thing is, you could have cashed in right alongside them. That's why I block out the media noise and pay attention to what truly matters, whether the insiders are investing in the company with their own money. That's how you learn the truth about where a stock is headed.
Did you see this in real time, Alex? Did you know that the Vince company had that kind of potential?
Yeah, it's interesting, Bill. The government requires that a company's insiders file within 48 hours of their purchase. So we knew almost immediately. And in the case of Vince Holding, I mentioned the stock to a small group of my readers when it was at exactly $6.10. Those who took action had the chance to pocket 272% gains in exactly 1 year, right alongside the insiders. It's a simple concept, Bill, but it's so effective. And you should know, I'm not the only one who believes this is so powerful. Same goes for the Oracle of Omaha, Warren Buffett, the famous and most successful investor of our era. Buffett says, I feel better when directors of our portfolio companies have had the experience of purchasing shares with their savings.
Now, Buffett's preferred strategy certainly seems smarter than using Wall Street ratings or listening to the media or even your broker. Remember, if your broker was a genius, he wouldn't be your broker. He'd be living on some island somewhere, all right? That's what I tell my broker, all right? I don't mind the recommendations, but they're not in stone. So we should be focused on what the insiders do with their money.
That's 100% correct, Bill.
Okay, Alex. The coronavirus scare has influenced the markets, and many of us, including me, had stops on our stocks, and they were sold.
Right.
Not a bad thing, if you want to preserve capital. But now the question becomes how you turn this chaotic panic from coronavirus into profits down the road, because there will be opportunity.
Yeah, absolutely. You know, the first thing to realize about this market break, Bill, is that the sell-off is entirely rational. Sometimes we see emotional sell-offs or sometimes inexplicable sell-offs in the market, but this is fundamental because as the coronavirus spreads, as it has been, that means people will go out less, that means they will spend less, that means retail sales will be down, that means corporate profits will be down. So what's important for investors now is to realize there are some companies that will be badly hurt by the coronavirus. We already know that airlines, cruise lines, hotels, brick and mortar retailers are all suffering as a result of the coronavirus. There are other companies, like healthcare companies, for instance, that won't have much change at all in their prospects. And there are even a few companies like, say, Netflix and Amazon and Stitch Fix, that if people stay in, their business will actually go up. So the important thing as an investor is to realize what's happening and to take advantage of opportunities that arise out of the chaos.
Now, what we're going to do today is indicate to people what the so-called smart money does, the inside money. Now, not insider trading or anything like that, but the people who understand what certain industries are.
Right.
And they may buy people, CEOs, and people attached to companies, but the public never knows that. They don't get that information.
Exactly. And here's the important thing to realize. These insiders don't know what the future of the coronavirus is. Nobody knows at this stage. What they do know is the prospects of that company are good enough or unaffected enough or improved enough, despite the virus, that they're still willing to buy millions of dollars worth of their own stock at that market price. So they're not oblivious to the coronavirus, and they're saying, we have a coronavirus, we have an economy that's reacting to it, and yet our share price is so cheap. Because there is no other reason to buy the stock. I mean, you can sell your stock as an insider for lots of reasons that have nothing to do with the outlook of the company. Maybe you're diversifying your portfolio. Maybe you're putting your kids through private school or buying a second home, or maybe you're getting divorced and you have to sell half your shares. But when you turn it around and say, why would an insider invest millions of dollars of their own money in their own company stock at the current market price? There is only one reason, and that's given everything they know about the prospects of the business, including lots of material, non-public information. They think the stock is trading for a lot less than what it's worth. It really is that simple.
Okay, Alex, before we go any further, let's help the folks at home understand this even better. Tell us first who qualifies as an insider. And folks, this is where you might want to start taking some notes. Alex is a true expert. This is what he does. He's been very successful for years, and he's going to give you some really good stuff.
Okay, Bill, from a legal standpoint, insiders are one of three things. They are officers, which means president, chairman, CEO, chief legal counsel who oversees the daily operation of the company, or they are directors who sit on the board and oversee those officers, or they are major shareholders, which means they own at least 10% of the outstanding shares of the company.
And what gives these insiders such a big advantage?
Well, insiders have access to all kinds of material, non-public information. These insiders see the day's receipts every evening. They know the direction of sales since the last quarterly report. They know about all the new products and services in development. They know if the company's just gained or lost any major corporate customers. They know the status of pending litigation. Sometimes they even know if someone wants to make an unsolicited takeover bid or even take the company private.
So having access to that information is obviously a huge advantage. If they know sales are skyrocketing, then of course, by buying the stock, they'll have a great chance to profit. Watching when insiders buy their own company stock is a way to get the truth out of them and the situation when it comes to how the business is doing. It's simple.
Yeah, that's absolutely right, Bill. That's why I call it the ultimate truth detector. Insider buying indicates higher future sales, new product launches, or big mergers. Here, let me give another example. Look at the financial tech company USA Technologies. In February 2019, there were negative reports about analyst downgrades on the company. And in May, the media posed this question: can USA Technologies stay alive?
Seems like a suggestion the company could go under.
Yeah, typical media fear tactics. A headline like that is alarming to most regular investors. But beneficial owner Doug Braunstein, through his firm Hudson Executive Capital, was loading up on shares. In fact, he bought more than $1 million in September at a price of just $4.43.
So that's an investment of about $4.5 million. Pretty big bet. Do you think he knew something was coming?
Well, let's look what happened. A few days later, a positive earnings announcement blasted shares up more than 30% in a single day. And from there, it just continued rising, topping $9 a share by January. His investment doubled, increasing his position by more than $5 million in just 5 months. Incredible. But here's the thing. Once again, you could have captured gains right alongside him. If you had timed it perfectly with this insider's buy, you could have quickly grown $10,000 into more than $20,000 over that same time frame.
Well, it's simple and effective. This is a smart and disciplined approach to the markets, and I'm sure our audience has a big question, however. I know I had this question when you first told me about the technique, Alex, and that is an insider trading illegal? People like Martha Stewart famously went to prison for it. What's the difference between what you're telling us, Alex, and what Martha Stewart did?
All right, that's a great question, Bill. Most folks believe all insider trading is illegal, but that's simply not true. What Martha Stewart did was illegal because she was trying to hide what she was doing. However, insiders are certainly allowed to legally buy shares in the company they run, but, and this is the important part, they must do it publicly. They must file this Form 4 with the SEC revealing what they're doing.
The government demands it, all right? And that's big because it means investors can track it.
That's correct. The federal government realizes that people with inside information have a huge unfair advantage over the little guy. And so, to level the playing field, anytime they buy or sell their own company shares, Uncle Sam requires them to file this so-called Form 4 with the SEC detailing how many shares they bought on what date and at what price. And once this information is public, we can act on it.
All right, 2 questions. They have to file it how fast after they buy it? How quickly?
48 hours.
Okay, so it's almost instantaneously.
Yeah.
The other thing is some of the examples that you gave us are guy buys the stock, it goes right up. Sometimes it doesn't go right up. Sometimes you have to be patient, right?
Right. Yeah, it's important to realize the insiders are prohibited from selling their stocks within 6 months of buying. So they're not buying it this week to sell it next week. However, we're not insiders ourselves, and so there are no restrictions on us. If they buy the stock this week and it rockets up next week, we can sell the shares or we can hang on for weeks, months, sometimes longer.
So the investor shouldn't say, oh, I'm going to get rich right away. He should be patient. This is a smart, disciplined strategy, but patience is a part of it.
That's correct. So my team and I utilize something called the Edgar database. It's the system used at the SEC to publicly track insider moves. And if you're a company insider and you want to buy or sell your own company's stock, you must file through this database. And I can tell you, Bill, from monitoring these insider trades for 2 decades now, that most insiders file the very same day they buy. So that's how I'm able to track every single insider purchase made daily. And when these filings take place, I'm among the first to know about it because we take a service that tracks them electronically.
I have to imagine there are thousands of filings reported daily. What exactly are you looking for?
Well, there's actually more than 2,000 Form 4s that flood into the Edgar system every day. And it would be overwhelming, if not nearly impossible, for any regular investor to analyze all these trades. So that's why I have a system that helps me to filter each as they come in. And I look for 4 specific things, Bill. The first is big purchases. I'm not interested in somebody who bought $10,000 because he was elected to the board. I'm looking for big 7- and 8-figure purchases that let me know that something huge is on the horizon. For instance, when I saw Abbott Laboratories CEO Mitch Wilkinson put $14.8 million into his business in November 2016, I knew I should take a closer look.
Yeah, that's a lot of money to put into a single stock. You're not going to risk that much, as we said, unless you're pretty sure the stock's going up.
That's right, Bill. The great Peter Lynch, who grew the Fidelity Magellan Fund from $18 million in assets to $14 billion, says, when an insider buys, they do it for one reason only. They think the price will rise. And in the case of Abbott Labs, I sent my readers a buy recommendation on November 28th, telling them to get in right alongside the CEO. And sure enough, just 2 months after he made his big investment, Abbott completed an acquisition of St. Jude Medical.
So it would appear the guy knew the acquisition was in the works. Maybe he had some idea it was going to push the stock up in value. I think that's a logical supposition.
Right. And once the news of the acquisition came out,